We often perceive war as a rupture, a catastrophic deviation from the norm, an external shock that derails the predictable trajectory of economies and societies. Yet, for those who scrutinize the deeper mechanics of global finance and power, war frequently emerges not merely as a destructive force, but as a profound catalyst for transformation, a crucible in which new economic orders are forged and, crucially, in which the power of central banks becomes astonishingly consolidated. This is not a mere side effect. It is, in many respects, a recurring feature, almost a playbook, for the expansion of monetary and fiscal authority. To truly grasp this dynamic, we must move beyond the superficial narratives of conflict and delve into the intricate relationship between national security, public finance, and the institutions designed to manage a nation's money supply. War, by its very nature, demands resources on an unparalleled scale. It necessitates the immediate redirection of productive capacity, labor, and capital toward a singular existential objective. This reorientation cannot occur within the conventional constraints of peacetime economics. The sheer speed and volume of funding required to wage modern conflict invariably push governments to their fiscal limits and often far beyond them. This is precisely where the central bank steps onto the main stage, not merely as a lender of last resort, but as the architect of financial mobilization. Before the advent of modern central banking, financing wars was a far more direct and often brutal affair. Monarchs and empires relied on direct taxation, the seizure of assets, the plunder of conquered territories, or borrowing from wealthy merchants and bankers at exorbitant rates. The limitations were stark: taxing too heavily risked rebellion. Direct seizure alienated the populace and productive classes. And private loans, while crucial, were finite and came with restrictive covenants. The capacity to wage prolonged, large-scale wars was thus inherently constrained by the immediate wealth of the state and its ability to compel its subjects or secure external credit. The 17th and 18th centuries saw the gradual emergence of national banks, initially chartered to manage government debt and facilitate trade, but their role in wartime finance remained largely secondary to direct taxation and borrowing from the private sector. The true paradigm shift arrived in the 19th and early 20th centuries as the scale of warfare industrialized and the concept of a dedicated, quasi-independent central monetary authority gained widespread acceptance. The Bank of England, the Banque de France, and later the Federal Reserve in the United States were designed with a dual mandate: to ensure monetary stability in peacetime and, critically, to provide financial resilience in times of national crisis. World War I provides the foundational case study for understanding the central bank's wartime playbook. When the guns of August roared in 1914, European nations accustomed to the gold standard and relatively conservative fiscal policies were suddenly confronted with financial demands previously unimaginable. Governments, initially optimistic about a short conflict, quickly realized the war would be protracted and incredibly expensive. The immediate response was to suspend gold convertibility, effectively freeing central banks from the constraint of physical reserves. This was the first crucial step toward unfettered monetary expansion. With the gold anchor cast aside, central banks could and did begin to monetize government debt on an unprecedented scale. Governments issued war bonds, but when private savings proved insufficient, central banks stepped in, purchasing these bonds directly or indirectly, often by extending credit to commercial banks that then bought the bonds. This process essentially creating money out of thin air allowed belligerent nations to finance their war efforts without immediate collapse. The consequence, however, was soaring inflation, a hidden tax on the populace that redistributed wealth and eroded savings, but kept the war machine funded. Central banks became not just facilitators, but active participants in the war economy. Their balance sheets swelled with government paper, and their power over the money supply was dramatically enhanced. They dictated interest rates, allocated credit, and became the ultimate arbiters of who received capital and on what terms, all under the umbrella of national necessity. The interwar period, marked by attempts to return to the gold standard, hyperinflation in nations like Germany, and ultimately the Great Depression, demonstrated the volatile legacy of wartime finance. The resulting economic instability directly contributed to the rise of totalitarian regimes and, tragically, to the outbreak of World War II. When that conflict erupted, the lessons of World War II represented the zenith of central bank involvement in war finance. The scale of mobilization was global and total, necessitating complete control over national economies. In the United States, the Federal Reserve became the primary financier of the war effort. The Treasury issued massive quantities of war bonds, and while patriotic appeals encouraged public subscription, the Fed ensured that any shortfall was met. It maintained a policy of pegging interest rates at extremely low levels, effectively allowing the government to borrow at minimal cost. This financial repression, as it would later be termed, meant that savers received negligible returns, but it guaranteed the government an endless supply of cheap credit. The Fed's balance sheet exploded, with its holdings of government debt becoming the dominant asset. Similar patterns unfolded in the UK, Germany, and Japan. Central banks directly monetized debt, imposed capital controls, and facilitated the rationing of resources. They became instruments of central planning, directing the flow of credit to industries deemed essential for the war effort while starving non-essential sectors. This was not just about managing money. It was about managing the entire productive capacity of a nation, coordinating industry, labor, and finance under a unified command structure. The exigencies of war provided the perfect justification for an unprecedented expansion of state power, with central banks acting as the engine room of this expansion. The mechanisms through which wars consolidate central bank control are multifaceted and deeply ingrained in the structure of modern economies. Firstly, there is the expansion of national debt. Wars are expensive, and governments rarely fund them solely through taxation, especially not without risking public unrest. The solution is borrowing. When governments borrow from central banks, either directly or indirectly through the purchase of government bonds in the open market, the central bank's balance sheet expands. This expansion represents an increase in the monetary base, effectively creating new money. This process, often termed debt monetization, gives the central bank immense power over the money supply. After the war, these debts remain, and their management becomes a central plank of economic policy. The central bank, as the largest holder or facilitator of this debt, continues to exert influence over interest rates, inflation, and the overall fiscal health of the nation. Secondly, inflation and monetary policy become critical tools. Wartime economies often experience significant inflation due to increased demand for goods and services driven by government spending coupled with reduced civilian supply, as resources are diverted to the war effort. Central banks, by controlling interest rates and the money supply, can either exacerbate or attempt to mitigate this inflation. More often, during the war, they accommodate it, as it serves to erode the real value of the national debt, making it easier for governments to repay their obligations. In the post-war period, controlling inflation becomes a primary mandate, giving central banks continued justification for intervention in the economy, setting interest rates, and engaging in open market operations. This ongoing management of inflation and deflation cycles solidifies their role as economic arbiters. Thirdly, capital controls and financial repression emerge as common wartime necessities. To prevent capital flight, maintain exchange rate stability, and direct savings toward war bonds, governments, often with central bank assistance, impose strict controls on the movement of money across borders, fix exchange rates, and cap interest rates at artificially low levels. These measures, while ostensibly temporary wartime exigencies, often persist long after the conflict ends, becoming normalized features of the financial landscape. They grant central banks and treasury departments immense power to allocate capital, influence investment decisions, and shape the post-war economic recovery according to state priorities rather than purely market forces. Fourthly, industrial mobilization and central planning become hallmarks of wartime economies. Modern warfare requires the coordinated output of entire industrial sectors from steel to chemicals, logistics to telecommunications. Every aspect of the economy is pressed into service. Central banks facilitate this by directing credit to essential industries, often at preferential rates, and by working hand-in-hand with government planning agencies. This expansion of central planning capabilities, justified by national emergency, leaves a lasting legacy. Governments and central banks gain experience and legitimacy in intervening directly in industrial policy, shaping national champions and influencing technological development powers that are seldom fully relinquished in peacetime. Finally, the post-war period frequently witnesses the creation of new global financial architectures, largely orchestrated by the victors and their central banking establishments. The most prominent example is the Bretton Woods system, established in 1944. Born from the ashes of World War II, this agreement established the International Monetary Fund, IMF, and the World Bank and pegged the world's currencies to the US dollar, which was in turn convertible to gold at a fixed rate. This system, conceived by economists like John Maynard Keynes and Harry Dexter White, represented an unprecedented consolidation of economic power. The US dollar, backed by the immense industrial and financial might of the United States, became the world's reserve currency, giving the Federal Reserve and the U.S. Treasury unparalleled influence over global trade and finance. Bretton Woods was a direct consequence of the war, designed to prevent the economic nationalism and competitive devaluations that had plagued the interwar period. It enshrined a system of managed exchange rates, capital controls, and multilateral institutions to provide financial stability and reconstruction aid. While seemingly beneficial for global stability, it simultaneously institutionalized the power of central banks and their governmental counterparts on an international scale. The IMF and World Bank, though international bodies, largely reflected the interests and economic philosophies of the dominant powers, granting them significant leverage over the economic policies of other nations, particularly those requiring financial assistance for post-war recovery or development. The legacy of war financing extends far beyond the immediate post-conflict period. The debt legacy itself is profound. Wars leave behind gargantuan national debts, which must either be serviced, inflated away, or restructured. Managing these debts becomes a primary driver of economic policy for decades. Central banks play a pivotal role here, often by keeping interest rates low for extended periods. Financial repression to reduce the cost of servicing the debt, or by tolerating higher inflation to erode its real value. This ongoing management of war debt ensures the central bank's continued centrality to economic policymaking, shaping everything from taxation to investment. Furthermore, wars often lead to an expansion of the state and central bank mandates. In the post-war era, central banks frequently acquire new responsibilities beyond mere price stability. Mandates for full employment, financial stability, and even economic growth become common. These expanded roles provide further justification for increased intervention in the economy, from quantitative easing to targeted lending programs. The crisis of war provides the political capital for these institutional shifts, which then become permanent fixtures of the economic landscape. The military-industrial complex, a term famously coined by President Eisenhower, is another enduring economic consequence of war that indirectly strengthens central bank influence. Sustained military spending, fueled by national security concerns arising from conflicts and geopolitical rivalries, creates entrenched economic interests. Large defense contractors, research institutions, and related industries become powerful lobbies for continued military expenditure. This constant demand for funding, often met through government borrowing facilitated by central banks, perpetuates a cycle in which war, or the threat of war, drives economic activity and consolidates financial power. Let's consider more contemporary examples. The Cold War, while not a direct hot conflict between superpowers, was an era of continuous proxy wars, an arms race, and ideological struggle. This era necessitated sustained, high levels of defense spending by both blocs. In the West, this meant continuous government borrowing and, consequently, a sustained role for central banks in managing public debt and ensuring financial stability amidst geopolitical tensions. The technological advancements spurred by the Cold War, from space exploration to computing, often originated from military research funded by the state and facilitated by the financial system, further intertwining national security with economic development and central bank policy. The post-9/11's War on Terror similarly illustrates this playbook. The military interventions in Afghanistan and Iraq, coupled with a vast expansion of the homeland security apparatus, were financed through massive increases in government debt. While initial public support was high, the long-term fiscal burden was substantial. Central banks, particularly the Federal Reserve, played a crucial role in ensuring the liquidity of financial markets during periods of uncertainty and in facilitating government borrowing. The expansion of surveillance technologies, often justified by also had significant economic implications, creating new industries and market segments that are deeply integrated into the state's security apparatus. The economic dislocations caused by these prolonged conflicts, from oil price shocks to supply chain disruptions, repeatedly called for central bank intervention, reinforcing their role as crisis managers. Even in more recent conflicts, such as the war in Ukraine, we observe the central bank playbook in action. Sanctions, an economic weapon, are coordinated through global financial systems, often involving central banks in their implementation. The resulting energy shocks, supply chain disruptions, and inflationary pressures necessitate aggressive monetary policy responses, such as interest rate hikes by central banks worldwide. These events underscore how geopolitical conflicts, even those not directly involving a nation's own military, compel central banks to take decisive actions that profoundly impact national and global economies, further integrating economic strategy with geopolitical maneuvering. The central bank's playbook, then, when viewed through the lens of history, reveals a consistent pattern. Wars provide the ultimate justification for extraordinary measures. The immediate and existential threat of conflict overrides conventional economic prudence, allowing for the rapid implementation of policies that would be politically impossible in peacetime. Firstly, crisis justification for expanded powers. War is the ultimate crisis. It allows central banks to shed their perceived independence and align directly with the state's objectives. Measures like suspending gold convertibility, monetizing debt, and imposing capital controls are presented as unavoidable necessities for national survival. Once these powers are invoked, they often create precedents and institutional capacities that are difficult to fully dismantle. Secondly, monetization of debt. This is the core mechanism. By purchasing government bonds, directly or indirectly, central banks provide the seemingly limitless financing that modern warfare demands. This process, while inflating the money supply, allows governments to avoid politically unpopular direct taxation at the scale required, shifting the burden onto future generations and currency holders through inflation. Thirdly, control over credit and capital. Wartime necessitates the redirection of resources. Central banks, through interest rate controls, credit allocation, and direct intervention, gain immense power to dictate where capital flows, ensuring it serves national priorities. This level of economic planning often leaves a lasting imprint on the structure of industries and national economies. Fourthly, shaping post-war economic architecture. The victor's peace extends to the economic realm. Major wars often conclude with the creation of new international financial institutions and agreements like Bretton Woods that solidify the economic dominance of the victorious powers and their central banking systems, establishing frameworks for global trade finance and monetary policy for decades to come. Finally, the long-term shift toward greater centralization and intervention. Each major conflict from the Napoleonic Wars to the World Wars and the Cold War has incrementally expanded the scope and scale of central bank operations and their integration with state power. The temporary measures often become permanent, solidifying the central bank's role as a pervasive force in managing not just money, but the entire national economy. In conclusion, the notion of war as a purely external, destructive event separate from the internal dynamics of economic and monetary policy is a dangerous simplification. Instead, history reveals a recurring pattern whereby wars, whether by design or emergent necessity, serve as profound catalysts for the consolidation of economic control, particularly in the hands of central banks. They provide the ultimate justification for unprecedented monetary expansion, debt monetization, financial repression, and the centralization of economic planning. The playbook is clear. Crises enable expansion, and war is the supreme crisis. Understanding this intrinsic link between conflict and central bank power is not merely an academic exercise. It is crucial for anyone seeking to comprehend the true forces shaping our global economy and the distribution of power within it. If you found this analysis insightful, please consider liking this video, subscribing to the channel for more deep dives into the mechanics of global power and finance, and sharing your thoughts in the comments below. Your engagement helps us continue this critical discussion.